All right. Good afternoon, traders. Some of you, good afternoon again. Hopefully, most of you are able to attend the trading room before coming on over. If not, welcome out. Happy Tuesday. Welcome to the Tradespoon Active Investor Workshop Series, our every other week opportunity to get together and talk concepts and strategies. Yeah? Concepts and strategies. I got a fresh cup of coffee in between. I hope you did the same. But today we're going to be discussing an advanced options strategy known as an iron condor. We'll talk about what makes it iron. I remember when I first learned, I'm like, iron condor, iron butterfly, iron maiden. Nope, that's a band, not an option strategy. What does it mean? What is the difference between a regular condor and an iron condor? So we'll talk about what it is, what it does, why we want to use it, when we would want to use it, and you know, it's we're a little early right now, generically speaking. Typically, we are looking at sideways conditions, and we'll go in and we'll kind of analyze the market a little bit. It might be a repeat for some of you. We're not going to go into heavy detail, just the model and the cyclical, and kind of talk about what we see now versus what we might expect to see come May. Sell in May, go away May, June, July, August, and everyone starts saying, "Oh, we've had 2 more hikes and it's a recession." We did have an inverted yield curve today. It went inverted. That's tends to be a sign of a recession, so we want to be aware of that. Hey, Chet, good to see you again. If I didn't say it already, hi, Thomas. So that's on the agenda. We'll build an iron condor, even though we might not necessarily be inclined to use this strategy now, as we seem to be in the throes of a bullish run on the market, and may have expectations of that continuing, but we are very close. So what this will do is give you maybe a few weeks to practice if you've never done one of these before we actually get right. If you're flying a new plane, don't jump in the plane, jump in the simulator. Take it for a virtual spin a few times. Maybe crash it once or twice just to see, and then go live. Nothing wrong with that at all. So, for those who don't know me, my name is Scott Beck, and I am the head trading coach here at Tradespoon. And I am lucky enough to get to hang out with you fine people this afternoon. A little bit about me. I have been trading over 20 years. I have been teaching for over 16 of those years. I do need to remind you, especially with this presentation, that trading in options in particular can involve substantial risk, may not be suitable for all investors. Please read characteristics and risks of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks, be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, and we're not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is solely for education and information purposes. Any strategies discussed, including examples using actual securities and price data, which we will do, are strictly for illustrative and educational purposes in order to simplify the math. Commissions, fees, margin, interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team at Tradespoon may have a financial interest in the securities presented and the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and a consultant of AOS Inc., which does business as Trading Block and Money Block, a FINRA and SIPC member broker-dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's materials not endorsed by the other. Okay, let's jump in. Let's jump right in. Talk about what we know. We know the market's been bullish, finished bullish today. How did we finish today? Bullish. Oh, there it is. Yield curve inverted. Good times. Russell 2.5%. NASDAQ almost 2. Dow 1. S&P 1.25. What are our concerns? Our concerns are hyperinflation. We talked a little bit about this. Stagflation. I'm not worried about it. Not yet. Maybe after some rate hikes and maybe the job market slows. And right now, the economy is working just fine. We're looking at 7% GDP numbers coming up, right? That's not stagnant. Is it artificial coming out of the pandemic? Probably, but it's there. It's growing. We're not that worried about stagflation. We're worried about hyperinflation and what the Fed's going to do. And over time, especially with the ongoing Russia-Ukraine scenario, investors eye their negotiations. Well, you better side eye it too, because I'm suspicious. I don't know about you. But there you have it, right? That's the market. So those are concerns. What other concerns? The VIX looks much better. The sector rotation doesn't. Everything. So the VIX is kind of my insight into the institutional sentiment. Now, why are we doing this? Well, because context matters. For any new option strategy, context matters. Eventually, I would like you to be fluent in option Greek, delta, theta, vega, gamma. Ooh, even right now, a little bit of rho. You don't talk about rho much. Rho gets left out often. But we are now in a rising interest rate environment. It's not all that fast, but rho becomes important. Rho tells us how sensitive our options to a change in interest rates, right? Money's getting more expensive. The value of time is going up. Therefore, the price of options will likely overall increase. Options are more expensive in a higher interest rate environment because money is more expensive. It's been cheap money. We've all gotten very used to it, right? How long money's been cheap. And when money's cheap, it puts an overall umbrella of general cheapness on the options. I don't remember trading options like I'm trying to think back to like literally 2001 and 2, 6% interest rates. And when they dropped with Greenspan cut them with the tech bubble crash, but I don't remember, quite honestly. It's been so long. So why is that important? Because delta tells me what do I want the trade to do by way of direction. Delta positive, I want it to go up. I make money if it goes up. Calls, bull call spreads, bull put spreads. We did a bull call spread today, right? Anything directionally biased to the upside. If you're delta negative, it's the opposite. You're directionally oriented to the downside, buying puts, selling call spreads, buying put spreads, etc., etc. And then there's delta neutral, and even that concept, I always think back, like when I first learned options, and then when I first started learning advanced option strategies, and like what stumped me, right? And this is one of them, along with iron. But delta neutral, like delta neutral. What do you mean delta neutral? Well, it means that the neutral of my trade is close to zero. I make money with a positive delta when it goes up. I make money with a negative delta if it goes down. So what do I want with a neutral delta? Nothing. I want it to stay right where it is, right? Why is that important? Because an iron condor is a delta neutral option strategy, a neutral. Now I can put that iron condor a little above or a little below, and in that case, I build a small bias to the upside or a small bias to the downside. But generally speaking, directionally, we're neutral, delta neutral. Well, if I'm not making money from the price going up or down, how am I making my money? Time. So what would my theta be? Theta positive. I make money every day I'm in the trade, and it should get more and more as it gets to the end of the trade, right? So if I think that, now, last variable, Vega negative, what does that mean? It means I make money if volatility drops. If I'm going to make money if volatility drops, it stands to reason I would prefer to enter when volatility were higher. We still have some vol. I mean, a lot of the volatility has come out. And you might think, well, great, if all the volatility came out, I missed my opportunity to do a condor. Well, we weren't neutral, right? So we have to find that balance, right? You might think, oh, well, when the VIX is at 50, I can put iron condors on. Well, yeah, they'll pay a lot, but You want to put a neutral trade on with a VIX of 50, that market's up and down and up and down, crazy amounts. So even as we learn iron condors, I want you thinking any strategy has these same principles and characteristics. I put a bull call spread on. What are the logistics of that? Delta positive. I want it to go up. Theta positive. I built it in. Now, not every spread. Some people mistakenly think that a credit spread is just always making money from time. That's just not true. You have to build the spread in a certain way in order to get that time decay on your side where you are theta positive. I make money from price going up. I make money from time ticking, and I am vega negative. I make money from volatility dropping. So if the market keeps going up, what's the volatility going to probably continue to do? Drop. So I have all three variables working on my side. This is a market where you need to be very, very careful about buying calls, right? And I know you're thinking, you're talking about spreads and calls. Why? Because these are all the building blocks. Buying options builds blocks to spreads. Spreads builds blocks to condors. Because that's all an iron condor is two spreads. Right? Now, let's talk about iron versus regular. What makes it iron? Two credit spreads makes it iron. A bear call spread on the top side, a bull put spread on the bottom side. What do I want it to do? Stay below the bear call, but above the bull put. So stay in the range, right? Now, those are both credit spreads. That makes it an iron condor. What would a regular condor look like? It would be two of the same series, meaning calls or puts. Two of the same series. So it would be a bull put and a bear put, or a bull call and a bear call. Those are condors. No iron, just condors. They all do exactly the same thing. They do exactly the same thing. But I do tend to prefer iron condors. Okay. Okay, where was I? Do you have slides? You know what, Sandy? So it's a funny thing when you ask about slides. But back, those of you who have been with me for a couple years know, back around the pandemic, we started doing presentations just kind of like, here's a concept. Now go. I didn't even know what I was doing a presentation on until like 30 minutes ago during the trading. I said, oh, look, iron condors, that'll be fun. And I feel like the presentation benefited. And I know some people are frustrated because they're like, where's my slides? And there's just not, but it's recorded. And so you can go back and take a few notes. But for me, it's very hard to convey this on slides. I need to intonate it. I hope you can appreciate that. But generally, the thought process is slides. We don't need no stinking slides. SPX Iron Condor, do you use support and resistance to establish the short strikes, or do you use delta instead? Great question, Cecil. Both are valid. Both are valid. I learned a lot about iron condors back in my prior days. I worked for Thinkorswim back when Thinkorswim was just Thinkorswim. Before Ameritrade came in, this is mid 2000s. But the general model from market makers is delta, 0.15 deltas. I mean, you're in some regard using delta as a probability measure in that regard, and you're trying to do kind of a higher probability. My answer to that question is yes, absolutely support and resistance, but not necessarily like the closest, but maybe like one previous resistance and one previous support to give us a little broader range. Let me change my screen so everyone knows it's still there to the SPY. And you can do SPX. SPX is an interesting thing. So right now you can see we're kind of in a run, right? What is iron condor time? You know, when is good iron condor time? if you're going to be in a sideways market, even this where it popped up just a little bit, right? Which when we talk about sell in May, go, remember delta neutral. What does delta neutral mean? Sideways. I want sideways. But this doesn't look sideways. This looks like it could pull back and then shoot up again. I told you I was going to show you two tools real quickly. Two tools. Tool number one, the toolbox. SPY, what does it look like? Bullish in the short term. Right? Whereas back here, it looked projected to go sideways in the short term. And that's something you could look at there. But this looks bullish in the short term. When does it not look? Well, if you look here, this is the cyclical model. This shows us a composite of the last 25 years, another one of our tools here in the Tradespoon platform. And you'll notice that end of March to April tends to be a really quite bullish time. And if you've ever heard the phrase sell in May and go away and wondered, where does that come from? It comes from right here. What happens in May and June? Pretty much nothing. Then we tend to have one little pop. And then what? A whole lot of more nothing. Summer doldrums. Right? It's harder to trade directionally. So what can we do? We can buffer it with delta neutral or time strategies, which would be iron condors. Okay. Another couple of my favorites would include calendar spreads and butterfly spreads. Calendar, butterfly, iron condor. And a lot of times it will depend on A, the range you think it's going to stay in, and that's where Cecil's question about support and resistance is very important. And B, what is the volatility? What do the options look like? If the volatility is very, very low, remember what we said, we're Vega negative. Anytime you have a trade that will be Vega negative, your preference is to put it on when volatility is higher and likely to drop. If the volatility is low, 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 and you think it might rise, you don't want Vega negative. That'll hurt you. It works against you. You want to be Vega positive. That would be a calendar spread. So butterfly and iron condor is pretty similar. Calendar spread, very big difference from a implied volatility standpoint. Back to what I was saying, this type of market where it starts to get bullish and it starts and the volatility is dropping, people will buy calls and the market goes up, but the time is decaying and you paid a lot for it because the implied volatility was high and because the Vega is negative, and as the volatility drops, you're losing money, and all of a sudden, right? Tell me if you've had this. You buy a call, the stock goes up, and your call does nothing. Nothing. You're like, I had a guy one time, and he said, Scott, I think my delta is broken. I said, well, that's interesting. I'm pretty sure deltas can't break, but tell me about it. That's the story he told. He bought it, went up a couple dollars, took 8 or 9 days. Time decay worked against him. Implied volatility dropped as it went up. Vega worked against him. And all the money made from Delta was lost on Theta and Vega. And the option broke even. Now, what if he would have sold a naked put? Bull put spread. Now, price is working for you. Time is working for you. Volatility is working for you. So as an options trader, always remember, context matters, always, which is why I spend so much time going through different market posture routines. How do I assess the institutions? How do I assess the options? How do I assess money flow and the trends? Because at any given time, why do I use multiple algorithmic models, mathematical models that are objective? Because it's important for us to be able to understand context. Okay, so now, right now, I'm not like, ooh, iron condor time, everybody. I'd be thinking, ooh, be careful. This thing could just make a run, and then we might see it just grind to a halt. Okay, so let's just assume we're now at the end of April. It's getting to be the beginning of May, and we're thinking to ourselves, okay, I think I'm gonna put an iron condor on. So let's go back to the chart now. So I hope you have a good sense of the theory behind this, the theory and why we're doing it. Now remember what we're constructing. We're constructing a bear call spread on one side, up in this area, not necessarily there. I just wanted to get it out of the way. And so this is the bear, better than slides. I'm writing on charts with my super nice handwriting. Bear call, and I'll be able to leave this here for a little bit. And then on the downside, what do we have? Bull put. These are just building blocks. How do I build a bull call or a bull put? I sell the closer to the money strike. So I'm selling this one here and I'm selling this one here. And then I buy the outer strikes in order to cover. Otherwise, they're naked. If all I did was sell the call and sell the put, that would be considered a naked strangle. But that's not what we're doing. We're doing an iron condor. So a naked strangle, and an iron condor are very, very similar. One just has much less margin requirement because it's much better protected. Okay, so how do we decide? So I said I might not take, I'm going to go yellow for this next color. I might not just take the most recent support. That's the most recent support here. And the most recent resistance, I would say, is probably maybe through here somewhere, right? So that would be a very aggressive iron condor. I don't have a lot of ability for that to break out one way or the other. Now, if I was going to put it on, I wouldn't want to put it when it was to the upper side anyways. What would I use? Well, then I'd probably go to the next level. I'm going to go green for this one. So to the downside, I would probably try to get down to that low, and to the upside, I would say maybe the all-time high, but we could probably get away with something right underneath that, not necessarily the highs. And you can see that might be a little bit better. Now, something to remember, I can put an iron condor on all at once, or I can leg in to the iron condor, which means I would put the bear call on first because I think it's at the upside. And then if it drops down, put the bull put on later. What will that do for me? It will get me more credit, right? Bigger credit, wider berth. Now, you can see in something like this, how far out in time do I go? Probably 30 to 60 days. 30 to 60, and that's a wide range because, well, there's, if you are more interested in making time value faster, you'd go 30 days. Harder to protect the trade, theta works for you at a faster rate. Or we have 60 days. What happens? I can protect the trade easier. If all of a sudden it makes a big move one way or the other, I can adapt, I can adjust, I can do something. But it's very slow in the beginning. I don't make as much money in the beginning. It's just not working as well, right? Because the theta is going to go slow, and then 30 days in, it'll start to behave like the other one we were considering, the 30-day. What do? I'll probably, Goldilocks it like I do a lot of times. Go for the middle, 45 days along those lines. So what do we have to do when we're building our iron condor, which is constructed with a bear call spread? A bear call is sell a call, buy one a little higher. And a bull put spread, a bull put is sell a put and buy one a little lower. So I have to decide what are those strikes. The options you buy, much less important. Some people go 1 strike wide, some people go 5 strikes, 5 points wide. There's a lot of different ways you can do that. That's the only thing the width of your strikes is going to control is your margin requirement. You are liable for the difference between the option that you sell and the option that you buy. On one side, it can't be above it and below it simultaneously. So your margin requirement will only be for one side or the other, but you get to collect 2 credits. Yeah, so you are liable for the gap between the option that you sell and the option that you buy. So the more narrow you go, the less margin you have to tie. but it has some implications of its own. So what do I have to decide? I have to decide A, how much time? 30 days, 45 days, 60 days. I have to decide B, where do I sell my call? So that's where I'm looking to find a level of resistance that I think is unlikely to be broken. And I'm usually going to go to the next resistance, not the most recent. C, I need to find the put that I'm going to sell. In this case, all the way down at the bottom. And then I've now got the basic construct. The next thing I have to decide is how wide am I going to make it? And I don't mean width between put and call. That's already been decided. I mean width between short option and long option, each of the individual spreads, which then determines my margin requirement. Once that's all been determined, I do want to have a look at it to try to assess the risk to some extent. And I will do so in order to position size the trade. Okay, so it's a pretty comprehensive look, right? A lot of people are like, oh, iron condor, throw it on. I disagree. Be methodical. Really understand, why am I putting this on in the situation that I am. I'm going to go ahead and build this in the paper account so that we can kind of see, like, okay, what would I get up here? So up here, we're talking about, around 470 to 475. Down here, we're talking about 415. So let's say 415 by 475. And we'll go about 45 days out. So let's just pop in and start building. I'm going to leave my marks there because we'll come back to that. So here's SPY. So what am I going to do? Well, in this trade, in this platform, it's very easy for me to, first of all, find 45 days out. You can see that 45 doesn't exist. It's 38 or 52. I'll probably go to this 52-day option just because. I'm going to set my spread to a iron condor. Now, I don't even, this is, if you ever use this platform, people will drive themselves crazy trying to like figure out the structure of this. Literally, it doesn't matter. You can click on any of these bids or any of these bids. This is to sell. These will do exactly the same thing. So if I click here one time, I've got an iron condor. That's not the iron condor that I want. That's just an iron condor. So what do I do with it? I adjust it. I take 460, I move it out here to 475. That's the call I'm selling. I take 459, I move it down here to 415. That's the put I'm selling. Let's just go 5 points wide. So I'm going to go up here to 480. And I'm going to come down here to 410. Remember, I'm going the same distance on the outside. So that's the option I sold. That's the option I sold. I went 5 higher and 5 lower. And now what do I have? I've got a $1.94 credit. What's my margin requirement? So you can see 410 by 415 is $5. 10 times $5,000. I have $5 on either side, but not both sides. That's why you can see my BP effect here says 5,000. What does this trade look like? So we'll dial this back. Let's maybe just look at like 4 contracts maybe. And we'll bring this back. Okay, now you can see this is my trade. So I make money anywhere between 415 and 475. Right now, you'll notice that I make money over here to the left. This trade is more oriented to the downside. We did that on purpose. Remember, I said we can orient this. We built, look how close it is to this green one versus this one. Of course, that's what it shows. So, if we were really going to do this, we would probably put it on when it was maybe somewhere closer to the middle down here. But just so this looks like what we would want it to look like, we're going to go ahead and keep it that way. Now, remember I said that we are mostly delta neutral. But in this regard, our sweet spot is down here. So we would want it to drop, right? Down here, you'll notice that's a drop towards 440. Delta negative means we're slightly bearish. Theta positive means I make money every day. Vega negative means I do better if the volatility drops. That's the trade. So how does this trade make money? Time. As time ticks, you can see it just keeps going higher and higher and higher. Now, in this case, we'd be able to start getting out of this trade in May, but in our situation, we're more inclined to think that we're going to take delta neutral trades in May. Right now, we're definitely thinking a little bit more directionally, or at least I think we should be thinking more directionally. So that right there, you can see that I have a lot of buildup because building the actual trade itself is not that hard. Once you know why you're doing it, that helps you know where you should do it. Once you know where you should do it, it's just a matter of starting to construct it. What goes first? The first consideration is always the options that I am selling, right? This one and this one. Selling at or near resistance, selling at or near support, broader term where we think this is the range it's going to stay in. Once we've decided that, remember, we already decided our time. Now you can see if I go a little bit shorter, if I say, you know what, I'm not going to go to May, I'm going to go to April. I'm going to do the April 18s. Whoop, that's February. That's wrong. April 15s. Let me go back to today. And let me go here to April 15. We'll go, actually, it's 14s because that's going to be Good Friday and Easter. You'll notice, first of all, look at my credit, 55 cents. So this little above ground structure here is not very big. If I go, let me show you May again so you can see the contrast. Boom. Look how high it sits. It's big and tall. $2 of credit, right? But if I all of a sudden think, oh, I want my theta to be faster. Well, okay, let me show you what happens. We go down to this. You'll see, yeah, your theta went from 8 to 15. You doubled your theta, but everything else is just, your risk out here on the outer edges is much greater. That's what I mean when I say the shorter the term, the harder it is to manage the risk if it breaks against you, right? Out here, you're losing $600 when it breaks out, and you only started making 220. But if I'm looking at the May options, out here, I'm risking a couple $100 and I'm starting with $800. Very different prospects. Now, if we get to May and the market does turn into that sideways market, you know, are we going to maybe look at some short-term ones that just get to expiration and we can just keep moving through them? Yeah. With this trade in May, I'm not thinking, oh, I'm going to wait till it to expire. If I get to 80% of my profit, I'm out. Right? So if I make 700 out of my 800, I'm done. I'm out of it. I'm not going to put it at risk. I'll have a new one on that I can be managing. If you do this, you look at it like inventory. So it's not like you put one on and that's it and sit on it for 30 days. You'll put one on for the next 30, then one on for the 30 after that, and one on for the 30 after that. And you're managing these like inventory, right? And as long as the market doesn't break out one way or the other, you're just sitting there making money from time decay. So it's not like, oh, let's just set it and walk away and then we come back and we make money. No, this is still an active strategy, but it's active from week to week, right? And it's not requiring, it's not so much a timing strategy as it is just a maintenance strategy. So when I get to May, it's not like I put one on for the end of August and then sit on it. I'm going to put one on for 30 to 45 days out in the first week of May. And then the second week of May, I'm going to put one for 30 to 45 days out, which is going to expire a week after that. And I'm going to basically ladder them. They're going to be kind of stacked up. And so if the market moves up, I'll put one on the upside. If it drops back down, it drops back into the first one. That's making money. Right? And as long as I build them wide enough and then properly exit if there's a significant breakout, I should be fine. I can just this is diversification for me. I don't believe we diversify by stock, right? Right now, I could find you 5 different charts, and then I can find you those same charts over and over and over and over again. So we're not diversifying by stock, but we can diversify by strategy, where we say, hey, I'm going to try to pick the direction in the summer. Of course I am. I'm going to try to find where the money's flowing, find some good sectors, find some strong stocks. I'm going to try, but I recognize it's going to be more difficult because it's just simply more difficult. That's not doesn't make you less of a trader to recognize that conditions matter. Context matters. It shows that we've adapted a level of humility that allows us to build the right trade strategy at the right time for the right reason, and then we manage it as such. So can I be directionally trading as well as sideways trading? Yeah, because if the market breaks out and I have to adjust or close an iron condor, wouldn't it be great if I had some bullish trades that are making money? Well, yeah, it would. So that's what we try to do. And then when it grinds sideways and my bullish trades are really struggling, wouldn't it be great if we had some iron condors that are just making money, sitting there. The longer they sit there, the more money you make. Boom, you're at 80%. Next week, boom, you're at 80%, right? And you're like, hey, okay, yeah, that is diversifying. So that's something you need to account for in regards to your risk management, right? So that you can be doing your directional trades while also doing your iron condor delta neutral strategies. These strategies can do quite well. Do you mind giving a hypothetical setup? Well, honestly, this is for me. This is the SPY. This is a trade. If I were neutral on it, I just feel like there's too much bullishness, too many signals. If this were the end of May, I would absolutely do a trade just like this. Look at the width of this. This is 60 points wide. 60 points wide. And I'm still getting a very good credit here. I would be looking to make $700 on this trade. And, if it were to break out, I would still have the ability, if I only, well, maybe I'd just close it. But yeah, I actually, I would say this is my hypothetical. But let's see if we can find something a little bit more neutral. Let me think if there's well, if the Dow may become a neutral. DIA will go. Now here's the thing about SPX. Okay, yeah, look, we can go with this. We can basically say we don't think it's going to get, so I'll maybe go 365 to the upside. SPX, why should you be careful? Because it's 10 times bigger than the SPY. It does offer some unique taxation characteristics. And let's maybe go right across the bottom down here. A lot of good touches there. 365, 340. Oh, we'll see. Maybe even the 340, right? Something like that. Okay. Let's go into analyze, add simulated trade. Same thing. I'm going to go out to May because it's easier to manage the trade. Pick one, anyone, doesn't matter. And then we said, right? I mean, look how, like I said, I hope you feel like by seeing how we try to set this up, it almost builds itself. That's the wrong chart. That's the wrong chart. It's this chart. Because you'll notice, what am I doing? I've already picked my time. I'm going to go out to the maze, a little beyond 52 days. I've already decided where I'm going to put my strike. Someone else might decide they're going to 370 and down here to 330. Great. We'll look at that one too, just so you can kind of get a sense. That one would be considered a high probability spread. High probability sounds great, but remember, high probability equals low credit. Credit and probability are on a teeter-totter with each other, so you have to be careful with that. So now I'm going to go, I keep forgetting my numbers. Sorry. 365 and 340. $365. What am I doing here? Oh my gosh. 365 and 340. And we'll go 5 points again. Actually, we'll go 2 on this one. So you can see that. So I'll go 342. Nope. 367. Where did I get that? 367. And down here, I'll go 338. Maybe. We'll see. We'll see if they have it. Not traded. Yeah, okay. I gotta go 5 wide again. And you'll notice on that 5 wide, I'm getting about the same $1.92. Pretty close. High, pretty good correlation there, right? Amongst SPY versus DIA. Okay. And this is what it looks like on the risk profile. And there we go. So you can see, where do I make money? Where do I lose money? I'm worried if it drops below 337. I'm worried if it gets above 365. I'm losing a lot more on this side than that side. So I'm again a little bit delta negative, but right now with the market having moved the way it is, that's just the way we're going to end up building spreads. So that would be it. That would be my trade, right? And it would be the Iron Condor would be from here to here and from here to here, and we want it to stay somewhere in the middle. Now, if you notice, with the exception of about 3 days here and about 2 weeks over here, the last 10 months we've been in this range. That's a good range. That's what you're thinking about, right? What's the range? What's the expiration? What's the range? How am I going to manage it if it goes against me? This is a trade that you would expect to be right over and over again. So if we can cut our loss when it goes against us, we should be able to be right on trades like this 60, 70% of the time. And if we cut our loss well, then our losses really should be no bigger than our gains. And that's the appeal. If I can be right 60 to 70% of the time with a 1-to-1 or less for the loss, reward to risk ratio, how much credit was on this? $1.92 on a $5 widespread. $1.92. So posture, neutral. Can be slightly bullish or slightly bearish, but mostly neutral. Considerations. Where do you put your bear call spread? Find resistance, find another resistance above that. Try to keep it up there. The higher you go, the higher the probability, the lower the credit. Then you find where you put your bull put spread, the other half of your condor. They don't have to go on at the same time. So in a situation like this, you might put a bear call on and then wait for it to drop and then put a bull put, or vice versa, legging in. But you can't put the whole trade on all at once. And when you have that neutrality. But you've got to decide, where do I put the bull put spread? And then you've got to recognize it's never really that neutral. There's always some element of directional bias. And it's important for you to understand what that directional bias is. Okay. You determine how much time you need. You then look at your potential for loss and adjust the contracts. Then you put the trade on and you sit back and you manage it. However, the next week, you'll probably do another one, and you'll probably have 4 or 5 of these rolling through, as long as your posture stays somewhat slightly bullish, slightly bearish, or neutral. If it gets strongly bullish or strongly bearish, iron condors are not your strategy. Just be directional. Make money from the direction. But if you maintain for months a sideways posture, you can continue to just do this week after week. One's closing, another one's opening. You're managing. You might take a loss here or there, but you're booking mostly gains. It's a great strategy. I'm a fan. Now, I do also think you can intermix it with butterflies and calendars. So if we get to a point where the VIX is back at 15 or lower, and you come to my trading rooms, you're gonna see me trade calendar spreads because it's one of my most favorite low implied volatility strategies. It's just phenomenally successful strategy. It's also neutral, right? It's a neutral trade, but it works better because it is Vega positive, right? So when the volatility is very low, you're going to find the iron condors just aren't paying you as much anymore. Do I prefer SPX, SPY, or individual stocks? SPY. If I'm trading bigger, I'll do SPX, but SPY, is easier to manage the risk. I like QQQ. I like DIA. Actually, DIA doesn't have the liquidity oftentimes. IWM, but we tend not to be as sideways on IWM, right? Or, really sideways tends to be the Dow, the DIA, and the S&P more. So those are probably the two I prefer the most. And just hope that the DIA liquidity is in place. I'm not a big fan of iron condors on individual stocks, except I will put them on in an earnings situation. So if there's an earnings announcement, I might put it on, and that's a short-term one. Watch the implied volatility fall apart, and then try to lock in most of the gains the next day. Whole different strategy, a lot more aggressive. But if you get into iron condors, that is certainly something that you can look at and look to work on. Okay, that's it. That's the strategy. I've got a few minutes for questions, so pepper me. Or you might just be thinking, it was a lot. Maybe you want to listen to the recording to go through it again. It's a great strategy. It makes a lot of sense in a neutral market, so make sure you're in a neutral market. Make sure you give it a wide enough berth. Make sure you give enough time. Make sure you have a plan to manage it. And again, I would say 60 to 70%. Winners should be at least as big, if not bigger than the losers. And that is a positive expectancy. Yes. All right. Nothing? You guys feeling good? Feeling ready for a sideways market come summertime? Make some money bullishly here, possibly, and then gear up and put a foxhole together, ready for the summer doldrums. We know what we're going to do. Do you have a credit goal based on the width of the spread? It's very difficult because the volatility is going to have such an impact, and you're kind of at that discretion. If it's more, what does the credit look like relative to the risk and the margin once I've established the spreads? So no, because if I could have, I might have done this one $2 wide, not $5 wide. And the width of the spread will have a determining factor. I'm more concerned with the risk profile. The risk profile will show me how much do I gain, how long does it take for time to kick in, how long do I need to hold on to this to get 80%, where would I need to close one side or the other so I'm ready if that happens. That's it. That's what I'm looking for. Cecil, I appreciate your questions. It's a quiet room today. I hopefully didn't shoot the fire hose too hard with the delta theta vega talks and short strike, long strike, and it's an advanced concept. Remember, it's building blocks. Buy calls, buy puts leads to spread trade calls, spread trade puts. Put them all together. What do you got? Condors, iron condors. They all have slightly different, objectives. It's important that we understand what the objectives are and why we're doing it. But other than that, it's good to go. Okay, well, those of you who only come to the active investor workshops, I'll see you in 2 weeks. And I won't know what we're talking about until the day of. Those of you who are coming to the trading rooms, I'll see you tomorrow in the afternoon. And again, Thursday in the afternoon, and then Friday in the morning. I hope you can join me for that. Interesting markets that we have right now. Futures already show us down a little bit. going into this. We'll see if this thing can hold or if we get a little bit of a consolidation. Is the iron condor for DA viable for today? Not for me, Ray. Not for me. There's too much bullishness. I need to be more convinced that the sideways market's coming. I think we could see a rally higher and really stretch it. So I think if I wait a little longer, I can build a better one based on the sideways summer that we tend to get. So bull put spreads, bull call spreads, yep, they make a little more sense. Although, I mean, we're extended. Look at it. We just went up for 2 weeks, right? You gotta think at some point you're chasing it. You gotta relax and see if it has a small consolidation, if nothing else. Well, it kind of had a consolidation, but even then we've gone up for 4 days since. So, you know, relax, take a look at it, be convinced. And there you go. My pleasure. Good to see everybody. I hope you enjoy the rest of your day. I hope you can join me the rest of this week. But if not, and even if so, happy trading.